I'd like to welcome David Garofalo, Chairman and CEO of Gold Royalty Corp. Dave was named Mining Person of the Year in 2012 by the Northern Miner. He was also Canada's CFO of the Year by Financial Executives International Canada in 2009, Top Gun CFO by Brendan Wood International 2009 and 2010, and he was recognized by IR Magazine for Best Investor Relations by his CEO in 2011. David is kind enough to join us all the way from Vancouver today, and I'd love to welcome David Garofalo to the show. Thanks for being here, David.
Hi, Alan. Delighted to be here.
Fantastic, fantastic. I get a lot of questions regarding gold. Is gold a good investment idea for me? How does the price of gold move? It's so volatile. Does it make sense? So I thought we'd start off the show and talking a bit about the price of gold. What causes the price of gold to move? Does it move like other metals? Does it move based on the U.S. dollar, supply, demand? What do you think moves the price of gold most, especially that we've seen recently, the price of gold moving up and down quite a bit? I think the other day I saw the price of gold actually down about $50 an ounce. So in your opinion, what would move the price of gold most, and what should investors be looking for?
Well, I think all the factors you mentioned earlier really do have an impact on gold, but predominantly gold is a currency. It has been a currency for 4 millennia. And currencies trade relative to each other based on relative interest rates. And gold, as a financial instrument, yields zero. However, treasuries these days, whether it's U.S. treasuries, Euro treasuries, Canadian treasuries, are actually yielding negative on a real basis. If you look at the nominal interest rate, less where the rate of inflation is. So in other words, inflation in its insidious nature is eating away at capital. If you own a treasury, you're losing a little bit of purchasing power every day. That's certainly not the case with gold. It maintains its intrinsic value. It has physical properties. It's not the obligation of any government, as fiat currencies are, and that's why gold is dominated as a currency for as long as it has. It's appreciated, relatively speaking, of late because of the state of real interest rates, which is in the negative territory. And it's our view that it's actually quite entrenched in negative territory. I think inflation is here to stay. And even as nominal rates go up, and the inflation rate seems to be accelerating, driving real interest rates down deeper and deeper into negative territory.
So you would say the inflation rate itself being as high as it is, and obviously central banks are trying to fight it right now by raising interest rates. So you would say the inflation being high today is really what's taken gold back up to near its all-time highs?
It is, and I believe that we have quite a bit more traction and quite a bit more upside than what we're experiencing right now, because even though the central banks are making motions to tame inflation, in fact, that's really not what they want to do, because the level of debt globally relative to where it was in the last big inflation cycle in the 1970s is considerably higher. Debt to GDP globally today is 350%. Back in the 1970s, it was only 100%. So the central banks back then had quite a bit of more latitude to raise interest rates in order to tame inflation. In fact, that's what they did. We saw interest rates go as high as 20% plus to tame headline inflation numbers that were 14, 15%. Today, there's really no appetite for central banks to raise nominal rates beyond the 6, 7, 8% headline inflation numbers, because that would actually bankrupt governments and put the fiscal balance in North America at severe jeopardy.
Yeah, it makes sense. And we talk on the show often about real rates of return. And you make a great point that obviously with inflation here in our country in and around 6%, you're looking at bond yields right now, even though they're significantly higher than they were at the start of 2022. Still, when you subtract inflation, a lot of these investment vehicles are earning a negative rate of return. So let's move over to, investments. Why would an investor own a gold mutual fund, a gold ETF, or a gold investment in general? Are they owning it do you see them owning it more for growth? Are they owning it as a hedge? Are they owning it even from more of a defensive, for defensive nature, against what's going to happen in the future? Why would you, recommend, or why should an investor consider owning a gold investment vehicle?
No, it's an excellent question. And if you believe in gold as an asset class and its ability to protect your savings in an inflationary environment and in low interest rate environment, low negative interest rates, then really you have to ask yourself, how do you best play gold to get optimum leverage to the gold price? And there are several ways to do it. You can buy the physical commodity. You can line up at the Bank of Nova Scotia or whatever bank with your driver's license, and then buy a bar, buy a coin, and store it in a safety deposit box under your mattress, as it were. And then you have storage costs to incur when you do that. But at least you have the protection, the physical properties that gold brings, its indestructibility and its fungibility. You can take gold anywhere in the world, and it's recognized for the intrinsic value that it brings to the table. You can also buy an ETF that's physically backed by gold, whether it's on Toronto or New York, and that gives you that kind of physical gold holding without having to worry about where to store it. You can buy mining equities, and what mining equities is provide you leverage through their profitability. As the gold price goes up, their profitability, their margins should go up disproportionately to the gold price and outperform. Unfortunately, mining companies are not immune from cost inflation that we're experiencing in the general economy. And so that's why after 30 plus years of building and operating mining companies, I've actually switched over to a royalty vehicle where we own royalties on the mines, and we get top line exposure without being exposed to the operating and capital costs of the mine. So we get a percentage of the gross revenue. That gives us leverage to the gold price upside while protecting our shareholders from inflation, but also gives us leverage to the exploration efforts of our operating partners. So when we own a royalty on the mine and the operator starts to explore around their deposits and grow it geologically, we get the benefit of that because our royalty extends to the geological growth of the deposit as well. So it's really the best of all worlds. And over time, it's vastly outperformed the commodity royalty companies have, and it's certainly vastly outperformed the mining companies that have that kind of cost inflation exposure.
And I guess it sounds like at reduced risk as compared to the other ways of owning gold.
Yeah, absolutely. And the other factor is the diversification we have in our portfolio. We have over 200 royalties in our portfolio. Even the biggest operating companies in the world, whether it's Barrick in Canada, Newmont in the US, can't hope to own more than 12 to 15 mines in their portfolio. It's impractical for them to operate more mines. So they can't nearly achieve the level of diversification that we're able to achieve within a royalty company, and the scalability. I run over 200 royalties in our portfolio with 8 employees. I could run 2,000 royalties with the same 8 employees. So every incremental dollar of revenue goes right to the bottom line. And within 10 months of our IPO, we were already paying a dividend.
So that kind of takes me to another question I get asked often is, how much gold is there in the world? Obviously, we look at certain commodities, metals, let's take oil, for example. There's always talk, how much oil is out there right now. And obviously oil is something that we need, even though we're trying to get better and better and more environmentally friendly, we still are relying on oil. But when it comes to gold, how much gold is there? You mentioned all these companies mining for it. Isn't most of the gold being held by central banks in various countries around the world, like China? Every once in a while we hear about China and their gold reserves, or India and their gold reserves, increasing their gold reserves. So how much gold actually is there? And are these companies still actively pulling it out of the ground as much as they were before? And who is stockpiling all the gold that they're getting right now?
No, it's an excellent question. And there's only about 200,000 metric tons of gold that's been mined since the beginning of time. And all of it is on the Earth's surface. Much of it is in central bank vaults as part of the reserves. A lot of it is around people's fingers and wrists. So it's all there. It's all available. It's all above surface. But just to give you a sense of how much 200,000 metric tons is, it could fit into an Olympic-sized swimming pool if you took all the gold in the world and melted it. So volumetrically, it's a tiny amount. And in fact, if you look at it as a percentage of people's asset portfolios globally, it's a small fraction of 1%. So as you can imagine, a small reallocation of weighting, of portfolio weighting into gold would have an explosive impact on the gold price because there's so little of it on the Earth's surface. And to give you an example, you mentioned China. China is the biggest producer of gold in the world as a country. They mine more of it than any other country in the world, but none of it leaves their shores. And in fact, on top of that, they're the biggest importer of gold in the world. They've surpassed and eclipsed India, which used to be traditionally, for cultural reasons, one of the biggest importers of gold, still is, but China's eclipsed them. What that tells you is at the individual level and at the government level within the central bank in China, they're diversifying into physical gold as rapidly as they can because they are concerned about the underlying fiat currencies globally and the undermining of those currencies through monetary expansion, low interest rates, both on a real and nominal basis.
It's interesting, China, they obviously buy a lot of U.S. debt, and U.S. dollars, Japan as well. So it's interesting to hear that China has taken in all this gold. Gold, as we know, a hedge against U.S. currency. And at the same time, they have a lot of money in U.S. currency. So they're kind of hedging their bets both ways. But you often hear that China is pulling back from the U.S. and U.S. dollars. You wonder if they're kind of betting more so on gold at this point than buying more dollars, whereas Japan seems to keep buying dollars and everyone around the world keeps buying US dollars as the most dominant currency. So I guess China, you're right, hedging their bets a little bit by owning a lot of gold, and sounds like they continue to buy more and more on an annual basis.
It's true. And it's not a coincidence that the US dollar, as the recognized reserve currency in the world, has the biggest reserves of gold at the central bank level by far. And so there is a correlation between the two. And China recognizes that. They recognize that if they want to create an alternative reserve currency, they need to physically back that with gold. Even though the US abandoned the gold standard back in the early 1970s in order to fund a war in Vietnam and print more money, it still recognizes the intrinsic value of having their currency backed by a lot of physical gold.
Yeah, it's interesting. My son did a project on currencies, and we talked about when the dollar was backed by gold back in the early 70s and how it all works. So very interesting. I guess my final question is a question that, again, sign of the times, right? Cryptocurrency. You hear a lot about how cryptocurrency now, Bitcoin in particular, I guess, is taking the place of gold. That a lot of the younger investors, the younger generation, instead of buying gold as a hedge against the US dollar, they're going into crypto. Do you think that has, I guess, dampened the price of gold at all? Do you think it's caused the price of gold to not get to as high as it is? Let's face it, we're seeing, like you said, inflation, interest rates as high as they've been in the last 40 years, yet gold seemed to top out in the $2,000 an ounce range. It didn't really go above that. You would have thought maybe you would have seen gold shoot to all-time new highs on a regular basis. Yet many believe that, individual investors, especially the younger generation, moving more money into crypto versus gold. Do you think that's having an effect on the price of gold?
I think in the short term, absolutely. And in particular, in the last couple of years, when we saw a flood of new capital go into cryptocurrencies, at one point, there were 8,000 different cryptocurrencies in the market. That's been somewhat rationalized given what's happened in that market. There's been a bit of a crash there. And I think the fundamental issue with many of those cryptocurrencies, they have no intrinsic value. They have no physical properties. They're not fungible. They're not recognizable as currency globally. You can take an ounce of gold in any country in over 240 countries in the world, and you'll get value for that gold. You can't say that with cryptocurrency. That being said, I believe Bitcoin's here to stay. I believe the blockchain is fundamentally changing the way we do business and driving transactional friction costs out of our system. And you need a digital currency in order to participate in that. But you don't need 8,000 of them. And you certainly don't need ones that have no physical properties. And the collapse of FTX demonstrated that they were creating currencies out of thin air. And, it was a kind of a perceived fiction that those currencies had value. And it was a fiction. Gold has been a currency for 4,000 years for a reason, and will continue to be the ultimate currency because it can't be printed. We're only adding about 2% to global supply per year. You asked about the state of mining earlier on. We only have 6 years of reserves in the ground as an industry. We haven't been replacing what we're depleting. They're down. Reserves are down for about 40% from their peak in 2012. So the supply is diminishing, and we don't have elasticity of supply to price. So gold could go to $3,000, $4,000 an ounce. The industry can't just turn on new supply. We're at about 97, 98% capacity utilization in the industry. Reserves are depleting. So we can't react given the lead time from discovery to first production of a new mine typically is 15 to 20 years. So there isn't that kind of reaction that you're going to see in supply in reaction to higher prices. Whereas with cryptocurrencies, if they go to the moon, somebody's just going to create another one. And that's exactly what happened. And that's why that house of cards collapsed the way it did.
Yeah, I agree. I've said the technology behind the crypto, I think, is here to stay, the blockchain technology. The question is, which of these currencies will stick around? It's kind of like, other things that have come and gone, other fads, whether it was the marijuana sector, many of the companies disappeared, unfortunately, and those, the largest ones, survived. And I think it's going to be the same thing with crypto. We'll have Bitcoin, perhaps, maybe one or two others. But I think at the end of the day, it's the technology behind the crypto that I think is beneficial to all these companies, and that will stay. So I agree with you 100%. David, thank you so much for being on the show today and giving us some insight into how gold works, the price of gold works. I think a lot of individual investors, they're always asking me, should I be adding some gold at this time, especially with inflation this high? You've given us some food for thought there. And, how the royalty investment works and all the different ways that you're offering investors an opportunity to invest in gold. I think that's fantastic. Again, thanks for coming in from Vancouver. I know it's a little earlier there than it is here. So thank you so much for being on the show.
Thank you, Alan.
All right, take care.